Click the bell icon to get latest videos from Ekeeda.
Hello friends, we'll be going through certain theoretical chapters of accountancy. The first part would be introduction to accounts. We'll go through certain gist of meanings and definitions. What are the process that we follow while we go through accountancy, while we understand accountancy. So, in the first instance, AICPA has defined accounting as the art of recording, classifying, summarizing in a significant manner and in terms of monetary value. So that means any transactions that you record has a significant process before that which we need to follow. So what are those process, what are those terms that you need to understand, that you need to follow, is something that we'll go through right now. So we have a step process we have mentioned here. It's a 7-step process. The first step being identification of transactions. When it comes to identification of transactions, it means you have to identify the nature of the transaction. Transactions which are of financial nature have to be recorded in the books of the accounts. Any transaction which is not of financial nature will be skipped from recording of the transactions. For example, if Mr. A pays electricity bill for his personal use and buys certain goods of rupees 30,000 for his company, of these two transactions what you have mentioned down here, one of it relates to personal reasons and one of it relates to financial transactions. So when you record the transactions in the books of accounts, transactions which have financial value will be recorded in the books of accounts here. For example, Mr. A has paid 30,000 for purchase of certain stock. So this transaction holds financial nature, which is for the business transaction. Hence, this transaction will be recorded in the books of accounts. Apart from the earlier example where we said Mr. A paid electricity bill which was used for his personal use has no value in terms of business. Hence, this transaction will be skipped. Had it been that this transaction is for financial nature or for business transaction, would have been recorded then, else we would have skipped it. So identification of the transaction being of financial nature is the key most important part when it comes to recording transactions. So the first step relates to identification of transactions. The second step, what we mention here, is measurement of these transactions. Now, when it comes to measurement of these transactions, it means we measure these transactions in terms of monetary value. As I mentioned here, that AICPA has defined accounting to be the art of recording, classifying, summarizing financial transactions and then recording the same in terms of monetary value. Hence, measuring the transactions in terms of monetary value becomes the second most important part of the process what we have followed. Now, after identification of transactions, we will have measuring these transactions as a second step followed by identification. When it comes to measuring any transactions, so as we said that any transaction which has been mentioned as financial transaction or identified as financial transaction needs to have a monetary value. Hence, for example, Mr. A, who has got goods worth rupees 50,000, has a monetary value of 50,000 which is used for business transactions. So this monetary value is known as measuring this specific business or financial transaction in terms of monetary value. So any transaction which has been identified as a financial transaction will definitely go as a monetary value, and the measurement of these transactions will be done in terms of monetary value itself. So the first step being identification of transaction, second step being measuring the transactions in terms of monetary value. Let's go on to the third step where we'll understand recording the transactions in a specifying manner. Now, any transaction which has been identified as a purchase transaction, as a business transaction, as a sale transaction and has a monetary value will be recorded in the books of the accounts. We have different books of accounts, for example, purchase book, sales register, purchase register, sales return register, etc. In these books, we mention these transactions which we have already classified as business transactions. Now, these recordings are really important because they form the base of how the exact and the summarizing of all these transactions will have an effect on the result of the company's financial position. Now, when we talk about results of financial position, that is a different category altogether, which we'll be studying later on in this lecture. However, when it comes to recording of these transactions, we'll be recording these transactions in the specific set of books. For example, if we have a purchase transaction, we'll be categorizing those purchase transactions under one book. If we have sales transactions, we'll be recording these sales transactions under one book. If we have certain expenses, if we have certain incomes, if we have certain gains, if we have certain loss, they will be categorized according to their category, and then they will be mentioned in the specific registers or specific books that we maintain. Now, after recording the third transactions or the third process that we have followed, we have a next process which is known as summarizing. As I said, that will be categorizing them. That means we'll be categorizing all these transactions under one specific roof. So as I said, if you have a purchase transaction, it will go under purchase register. That is known as summarizing these transactions after recording these transactions. Once you have recorded the transactions, you will go ahead and record and summarize these transactions under one category. So, for example, if Mr. A has purchased certain goods of rupees 30,000 and has made a sale of rupees 50,000, both these two different transactions will be recorded in two different groups or two different books. So, the purchase transaction goes under purchase book and the sales transaction goes under sales book. This categorizing is known as summarizing the transactions. So, as per the definition, accounting being the art of recording, classifying and summarizing in a significant manner. This is what we were talking about. Once this recording and summarizing has been done, we'll be going ahead and analyzing and interpreting these transactions. Now, to understand the financial position of any company, there is a chartered accountant who goes ahead and interprets the transactions which have been summarized and recorded. Once the summary has been provided to him, he goes ahead and sees whether we are making profit, whether we are making loss. When this data has been provided to a chartered accountant, he goes ahead, analyzes and interprets the financial position of the company. He does this by the summarizing report that we provide to him. For example, if a chartered accountant has been given the results of the transactions which have been mentioned in the profit and loss account or the balance sheet, he goes ahead and does his analysis on it. He finds out whether there are certain policy changes that are required in these transactions, or there is certain improvement that we need to get in the existing policy itself. For example, if we have more of liabilities and less of assets, that means we are at the verge of getting bankrupt, or we are either at the verge of making loss. Now here, we need to make sure we need to cut down certain expenses. We need to cut down certain expenses which are more hampering the business assets value. So this analysis and interpretation is done by a chartered accountant or any authorized person who is skilled in making those analysis and interpretation. So after you record these transactions and after you summarize them, you go on the fifth and the sixth step, which is analysis and interpretation. Once this is done, once we have a finalized balance sheet and profit and loss account with us, we go ahead and communicate these details to our users. Now, these users are either external users or internal users. When we talk about users, these users are the most prominent people who have interest in the growth of the company. External users being the investors, the creditors, the lenders, the stockholders, every other person who wants to invest in the company and is a lender of the company or is the creditor of the company will require these details to understand where his company stands, where his investment stands in terms of the company money being invested. When it comes to internal users, we have this data to be shared with our VP. It may be the managing directors, it may be the board of directors who will go ahead and make sure that if there is any existing policy which is hampering their current sales, which is hampering their current profits, and if there are certain changes that needs to be made right down there, they will go ahead and make those necessary changes. Now, when it comes to users, it may be external, internal, and when we decide about these parts, these reports which we have analyzed, interpreted, recorded, summarized will be providing the base for any interpretation, for any decision making. So, we'll be going through more of these transactions in our next video. Thank you for watching Ekeeda. Keep subscribing to Ekeeda.